Hello, everybody. So today I want to talk about two events which, when you look at them at first, it makes me upset, makes me feel upset about, the market in general, the economy. And really, when you're deeply thinking about it, I think we growth investors, hyper growth investors with a well diversified portfolio of growth stocks should feel very bullish about what is happening, because everything that is happening is very short term and has nothing to do with the long term prospects of many of the companies that we have. So the first troubling event that happened today was the President of the United States standing in Michigan in front of a GM plant striking and making a speech. And if you watch that speech, you see the theme. The theme is the defeat of corporate greed. And, you've probably been following this closely for the past, more than a week now. Frankly, the media is very annoying about this. But essentially, the issue is they want a raise. Right, and when I look at, there's different sources. Some who are very pro-union say they make $18 an hour. Those who are very anti-union say they make something like $260,000 a year, as much I've seen. So, really, really tough to tell what's the pay. But the median pay, according to ABC News, is $80,000 for a GM factory worker, and for a Ford factory worker, $74,000. That's according to ABC News. They want a 40% increase, so that would be $112,000 and $104,000 respectively. I'm not making a value statement as to whether that's high or not. That's not. I really is not. It's not my issue. Not a big issue. Whatever. They want a raise. The problem to me is the narrative. This is upsetting to a lot of people, that raise that they want, because it's creating this horrible narrative. This is like all they've been talking about for 2 weeks. This short-term driven narrative. I was listening to CNBC the other day. They're afraid this is going to lead to wage inflation, and you have this whole wage inflation narrative which is coming back at the forefront of the news, and this is emboldening the Fed to tighten more. Workers are asking for higher wages, and this is going to create a loop, a wages prices loop, right? You see the supply chain disruption narrative coming back, where prices are going up, prices will go up because those factories are shut down and closed. Yeah, it's likely going to be true, but just because the prices go up doesn't mean people want to buy these cars, right? I mean, Tesla is sitting in the back selling way more cars. And also, over crazy statistics, I've seen statistics as many as multiple billions a day that are lost, especially in states in the Midwest, because of that strike. And the UAW has more than 100,000 workers, so this could spread to more than 100,000 workers. And you see all of these terrible headlines, terrible news about this strike. And seeing this video, this is just going to embolden the news, and that's all they're going to talk about tonight on the news and tomorrow, because now we have the videos of the president on strike. It's like, this is bad market sentiment, but really, as for me, for example, Tesla is 30% of my portfolio. Should I really be upset about this? If you are really a long-term thinker, I think it's important to realize that these strikes are actually wonderful if you are exposed to growth. So anybody who has a Tesla position, and doesn't need to be as high as mine at 30%, which, by the way, some people are 100% Tesla, but this is wonderful over the long term for Tesla, because that means that the competition is not going to be there. And even if you own a growth fund, say in your retirement, likely most of them are going to be 4%-ish Tesla in a growth fund. So even then, this is great news. This is going to help you outperform, because of course the big three automakers, GM, Ford, and Stellantis, are barely represented in the indices, and they're in the S&P 500 still. But I've made videos before as to why I don't think it's a good idea. I mean, it's not investment advice, but to me, I would not touch the S&P 500 with a 10-foot pole. It's filled with companies who are ripe for disruption, and sometimes even ripe for outright deletion of the index, like Silicon Valley Bank, right? It was outright deleted. Like the S&P 500 shrunk by 50 billion, deleted in 2 days. In 2 days. So anyways, so when you realistically, when I see this, I'm like, this is a very good thing over the long run for Tesla. So Tesla, a stock like Tesla and any growth stocks are hurting right now because of a short-term narrative of the strike. But if you look over the long run, the IRA bill is here for 10 years, and it benefits North American-made EVs. By the way, most European and most Asian EVs are not going to be eligible, or are currently not eligible, or it will take years before they become eligible, because they have to make the product in the US. So they're out mostly. And then the players that are still in, companies like Ford, GM, and Stellantis, and Tesla, these are the main players. And the competition that is coming, which you've been hearing for the Tesla bears for the longest time, right now is on strike. So that competition is really delayed, to say the least. And this is where I think this is even more important, is you have now CEOs who are facing an existential threat with EVs. I'm talking about the leaders of Ford and GM and Stellantis, and they're spending these precious attentional resources dealing and negotiating with unions, as opposed to designing the vehicles of the future, designing the factories of the future, actually dealing with the fact that you need 30% less employees to make an electric cars, and likely you need way less than 30% less employees. Sorry, you need way more. You need probably way less, because they are going to be automated factory lines. These factory lines need to be mostly automated. So anyways, any deal, and this is another point, let's keep in mind, they're losing money, right? Ford, GM, and Stellantis are losing money on every EV that they sell. These losses are going to be increased, because that's going to hurt the profitability of the big three EVs. That's going to hurt their profitability if you have to raise your labor costs by 40%. Furthermore, another even bigger problem of unions is that they actually create much more of a problem than, say, the cost or the draw of attentional resources. But they also control much more than just pay. They control the nature of work. You may have also seen that not only do they want that 40% raise, but they also want to work only 4 days. So the fact that unions have to be involved in these factories, in the way you manufacture anything, hinders the speed of change. It makes change slower. Even think about the way these contracts are negotiated. These contracts are negotiated over a 4-year period. It's kind of like companies that have budget, like a 5-year budget or a 2-year budget, and you say, oh, it's not in the budget, we can't do it. Well, the same is also true. So that means that the nature of your workforce is going to be set for 4 years. So much can happen in 4 years. In 4 years, the big three automakers, companies like Ford, went from praised in 2019, praised as to how much money they make with the F-150, to now a threatened company. That happened in the span of 4 years, of 4 short years. Right? Go back to 2019, 2018. These three companies were not threatened at all. 4 years was enough to entirely change the narrative. And you're locking your labor for a 4-year contract. Think about how this is going to hurt them and benefit Tesla. So this is short-term pain for the market as a whole, but if you are a growth investor and if you have exposure to Tesla, this is extremely bullish for you. Which is why, if you watch the Tesla community, all of the Tesla videos that I've covered this extensively, they're all super excited about this strike. They think this strike is wonderful. I've seen many Tesla YouTubers actually hope that the union workers get their deal and get a 40% raise. And quite frankly, if one were to act a little selfishly, I would say, as a 30% shareholder of Tesla, I kind of hope that those workers get a 40% raise. I might even think they should get a 50% rate with 3-day work week. That'd be much better for them, right? Anyways, so over a long term, it's good. Over a short term, it's bad. Here's another one today, which is what spooked the market today. This is Neel Kashkari, the head of the Minneapolis Fed right here. And this man today did an essay. He does essays. So he did an essay today in which he conjectured about the future of rate hikes and how they may happen. And in that essay, he said that the economic flywheel is still spinning. And if you go back to the prior speech 12 years ago, the Fed is they were hoping for a mitigation of the economy or a slowdown in wage growth. So they were hoping essentially for unemployment and struggle. Well, the struggle of the unemployment is not showing yet in their lagging indicator. And because this is not showing yet in the lagging indicator, they say, oh, we may need way more rate hikes. But this is the same story as the auto workers, exactly the same story. The Fed is looking at the past metrics of the past, the way it's been, and it's looking at the rear view mirror to make policy. So is the UAW. The UAW is looking at prior profits as a basis to ask for a raise. We are looking at prior successes of these automakers and saying, well, we need a raise for the next 4 years because you've had prior success, ignoring the world of struggle that is coming over the next 4 years, ignoring it, just looking at the past. That's short-term thinking, right? If you look at a company like UAW, well, that is short-term thinking because they are trading off a raise tomorrow against the end of the company and the eventual bankruptcy of the company 4 years from now, right? The same is true for the Fed by raising rates. By raising rates, they are trading off the innovations of today by killing many innovative companies in hopes that you actually stop inflation. And that inflation is not coming anyways. Because if you look qualitatively at the facts, that inflation is not coming. In my view, if you use forward-looking critical thinking, it is clear that that is deflation that is coming. Because deflation is the nature of capitalism. It has always been the case. When monetary printing does not outpace productivity makes things cheaper. That is the nature of the world. In fact, today, compared today to just 20 years ago, today we have nearly free music, right? $10 a month with Spotify or Apple Music. We have nearly free entertainment, right? $20 a month. We have fully free communication, entirely free. You just use Google Meet or you just use Skype, it's free. We have computing power for nearly free on our phones that we could not even hope for just 10 years ago. We have all of this nearly free, and we have more nearly free disruption that is coming, right? EVs are going to be a major disruptor. They cost next to nothing to power compared to gas cars, 10 times cheaper. Electricity itself is getting disrupted. People are going to make their own electricity. And this when you have power that is nearly free, marginal cost of energy is tending towards zero, then imagine all of the things that are going to be nearly free. You know, it's crazy. It's crazy when you really think about this. We have other disruptions in the way we organize business models. We have newer, better business models for today that are collapsing the cost of healthcare, collapsing the cost of banking. So many industries that I cover on the channel are going to enter in deflationary setups. Right? But no, qualitative thinking is not what is used by the short-term thinkers. The short-term thinkers use the lagging indicators. They use what they know today, and they don't make predictions that are going to be, 3 years out, 5 years out, and that require thinking multiple steps ahead. And there's many reasons why they don't do that. One of them, for example, is career risk. You have career risk. You're not going to be promoted if you start thinking long term. This is true for both of these stories. Whether it is the story of politics or whether it is the story of one of the Fed heads, one of the heads of the Fed, that's the same story. You have a career risk if you think more than a few years out, or if you do something that will have a great benefit over long term. So this is not a bad thing for growth investors. This is actually a wonderful thing for growth investors. And I want to think more of this way because, of course, when you see the portfolio down like today's drop in prices is the worst since March. So we haven't had a day as bad in the stock market as today since March of 2023. Okay, so it's been 6 months since we've had a bad day like today. And of course, when you see the red on the account, when you see all of these headlines, it hurts to see this red. That's just the nature. That's prospect theory. That's the way our brain is wired. But the truth is, when you think about this for the long run, when you think about this objectively for the long run, And when I think about all the viewers of the channel, thank you very much if you watch my channel, I really appreciate it. 70% of my viewers are between 25 and 45. So what this means is that for most people, we are still in the accumulation stage. We are still, for most people watching the channel, like the only exception if you're going to be 60 plus, but if you're not 60 plus, you're in the accumulation stage. You have more stocks to acquire going forward than you've acquired. So this is a great thing. Lower stock prices are painful today, but they are a blessing in the long run. I am supremely confident that this is the right way to think. And that way, that's why I say in this video, and as the title of the video, I am thankful for those who think with a rear view mirror and who look back and do policy based on looking back at what was and not looking at where the world is headed, because this creates turmoil in the market, and these are opportunities for many of the stocks that I cover on the channel. There is a dark side to that too, which is you kill innovation and you delay innovation, and I might cover that in another video. But anyways, this is it for today. So this was my attempt at another macro video. Hopefully you enjoyed it. This is not investment advice. This is just entertainment. I appreciate your likes. I appreciate your subscribes. Thank you so much for watching, and have a great day.